Welcome to Morningstar. Higher fees can eat into investor returns, meaning that investors are better served with a low-cost investment vehicle. Morningstar's research, academics, and Vanguard's Jack Bogle agree on this. While fees are just one among many variables in investing, we need to understand how we are charged and how fees contribute to our financial success. Today, we have Stephanie Yuen from Endowus to discuss this further. Stephanie, what are some conventional fees that investors face when buying funds in Hong Kong?
Yes, unfortunately in Hong Kong, it's constantly ranked as one of the most expensive jurisdictions to buy funds. And typically clients have two types of fees they have to pay. The one-off transactional fees, such as subscription fees, and some platforms continue to even charge withdrawal fees or switch fees. But little known are ongoing fees that are sort of quote unquote hidden in management fees of funds. These are called trailer fees in our industry. These are essentially commissions that fund houses have to pay distributors as long as clients continue to hold funds with the distributor. And these fees could be as high as 50 to 60% of the fund management fee.
So as you know, fees can impact investment outcomes and investor experience. Tell us more about it.
Exactly. As financial advisor, we always tell our clients, you cannot control how the markets go tomorrow, whether it goes up and down, but fees are something that you can really control. And all of us have heard of the sort of compounding as the eighth wonder in the world. But people tend to only focus on returns compounding, but fees actually also compound. So Endowus actually has done sort of analyses, and we've actually had graphical representation of this. And a lot of clients were shocked when they find out, let's say if you have 100 basis point or 1% difference in fees in your portfolio over a 30-year period, your investment returns could differ by 240%. So it could really eat into your investment returns and create sort of very different investor outcomes.
That's interesting. And to deal with this fee problem, Endowus has a unique fee structure. What makes it so?
Exactly. So Endowus was really founded upon sort of solving one of the pain points of Asian investors, including Hong Kong and Singapore. And part of the issue is high fees. And why there are high fees? Part of the reason is that the fund distribution structure in this part of the world is quite concentrated in a few players. And it creates a vicious cycle that a lot of fund houses, to fight for the coveted fund shelf on these popular distributors, they then fight for paying higher commissions to the distributors. And it means sort of higher management fees and higher expense ratio products that clients ultimately have to buy. So at Endowus, we wanted to bring a different model to solve for this issue, because high commissions, sort of trailer commissions fee, also create another issue of potential conflict of interest, where potentially distributors might want to push higher commission products and not necessarily the most suitable products for clients. So at Endowus, we run what we call a fee-only distribution model, and what we call it's conflict-free, because we're only paid by clients. We charge clients a all-in transparent 0.1 to 0.6% advisory fee all in, and we don't take any other sort of revenue sources, no trailer commissions. We rebate 100% of the trailer fees that we receive from fund houses, and we don't charge any transactional fees, so that we are aligned with client interest. And our only concern is to help our clients find the best products at the lowest cost to help them invest better.
Right. So last fee question for you. In Hong Kong, many of us have experience trading US listed ETFs. What is the investing cost angle to it?
So yes, because of the US dollar, Hong Kong dollar peg, US listed ETFs are very popular with Hong Kong investors. And obviously cost is a big issue. So you have large ETFs such as VOO, the expense ratio is sort of single digit basis point. But I think as a financial advisor, we often raise a point to clients that they might not be aware that as a sort of Asian investor investing in US listed ETFs, although you don't have the capital gains tax, you do have 30% with dividend withholding tax. So for ETFs that don't pay a lot of dividends, it might not matter a lot. But for example, I was just looking it up earlier today. If I want emerging markets, VWO, it's 3.5% dividend yield. If you slap on the 30% withholding tax, although the ETF itself is very cheap, it's 8 basis points. But if you slap on that withholding tax, the total expense ratio then goes up to almost 1%. So that's a huge, big difference. And that's why sometimes UCITS fund structure could be as competitive because we don't have that withholding tax issue. And this is sort of a good point, Kate, that you raised, that we always want to sort of let clients be aware, because a lot of clients in Asia like to invest in income sort of products.
Wonderful, Stephanie. That's very clear. For Morningstar, I'm Caitlin.